Hey, today I want to talk to you about a subject that has always been of huge interest to me. Over the years, the concept of index funds has been growing very fast across the world, and today I will touch upon index funds in my video. Now, as an investor, you have a range of investment options before you, and sometimes it can be very complex to decide where to invest your money. I like to always discuss principles and leave the final decision to the viewers. If you look at any investment option, there are two key variables among many others that you need to consider. The first one, of course, is the rate of return. What is the expected rate of return from the investment? The second one is the likelihood of achieving the estimated return, which I refer to as a probability. How likely is the investment going to deliver the estimated return? Now, in order to explain the concept, let us consider the most common option, a fixed deposit in a bank. Fixed deposits have a high probability of delivering the estimated returns, but they suffer from a relatively low rate of return. Hence, we will place fixed deposits in the quadrant on the right-hand bottom side. I have deliberately left out direct investments into individual stocks, as this is a slightly more complex area and may not be suitable for a small individual investor. That leaves us with investments in mutual funds. Actively managed mutual funds are known to give higher rate of returns, but bear in mind that the rate of return could range between very low to very high. And here, the probability of delivering returns may be medium in the long term. Some funds could deliver high returns while others might deliver lower returns. In the end, everybody doesn't make money in the market. It's only half of us who actually end up making money, while the others, of course, lose money. That leaves us with index funds. These are passively managed funds and track the performance of the respective index, that is, the Sensex or the Nifty or a wider group of products. Since the fund covers a wider range of stocks, the performance of the index usually tracks the performance of the overall market. Data suggests that the index funds give reasonable returns relative to inflation, but have a higher likelihood of delivering those. Here, I have illustrated the performance of the Sensex over the last 6 years. I am assuming that you invest on the first day of each year, while in reality you could be investing during the entire year. If you had invested on the 1st of Jan 2015 and based on the closing of the Sensex on 31st of December 2020, you would have achieved a compounded annual growth rate of 9.6%. Whereas, if you had invested on the 1st of Jan 2016, you would have achieved 12.8 compounded annual growth rate by the end of 2020. Here, I have shown you the CAGR you would have achieved if you had invested on the first day of each year over the last 6 years. Now, do I recommend that you invest in index funds? Not really. I can only explain the principles to you and leave the decision making to you. But when you look at an investment, it is important that you balance the rate of return and the probability of achieving that return based on your own circumstances and risk appetite. I personally find index funds a very interesting route to building wealth over a period of time. Before I sign off, I want to once again draw your attention to the principle of diversification. It is important that you diversify your investment portfolio in order to ensure that you balance the returns and the risk that comes with it. If you have any question, please comment below and I will be happy to respond back at the earliest. Thank you.